General Motors reported a phenomenal quarter on Tuesday morning. Second quarter results were better than expected. They increased guidance for the full year, but the stock's down 5 or 6% as I'm recording early on Tuesday. So what in the world is going on with the stock? It's a little bit hard to explain because results were really positive. They continue to buy back stock. That's really the weapon that they're using against this relatively low stock price. But it seems like investors are always finding something to criticize in the results. I'm not sure if it's China or their strategy in electric vehicles, which is going to actually reduce profitability, which is going to reduce their profitability later this year, but that should actually make them pretty well positioned for 2025 in EVs. But I want to go through the results and exactly what I took from the quarter. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So I'm going to show the market's reaction first. So like I said, as I'm recording, shares are down about 5.7%. So I just think it's an interesting reaction with such an earnings beat. You can see that the PE ratio, according to Google Finance right now, about 5.7. So very, very low value company, and continues to drop despite earnings doing really well. So not sure exactly what the market was looking for, but you can see here from the highlights of the results that this was a phenomenal quarter from a revenue perspective. EBIT adjusted, which is a way that they measure profitability for General Motors, $4.4 billion, adjusted auto free cash flow, $5.3 billion. I'll get to their guidance in just a second, but and then earnings per share on an adjusted basis, $3.06. Ended the quarter with 1.14 billion fully diluted share count. That was down 18% from a year ago. Might remember they announced a $10 billion buyback program late in November in 2023. So that is being executed. That's why the share count is down as much as it is. And then added another $6 billion to that about a month ago. So their plan is to get down to about $1 billion in shares outstanding. But trucks and SUVs continue to be the story for General Motors. That's the way this business is built. This is where they're going to make most of their money. And they have not had to give up price. I think this was really the interesting thing, was that revenue was up and actually their sale prices were up in the quarter for things like trucks and SUVs. So not the same competitive environment than as you see in something like electric vehicles, where costs are coming down really quickly. These refreshed SUVs appear to be extremely successful. Buick has some new vehicles that are growing really well, and then they're also revamping things like the Chevy Traverse. Will be a little bit more of more aggressive styling, and then these small SUVs, kind of hatchback designs, have done really well. The Buick Envista and Chevy Trax are a couple that they have highlighted, and those have been growing really well as well. Electric vehicles got a lot of talk on the conference call. Obviously, analysts are looking for how quickly are they going to move into electric vehicles. They said they're still targeting producing 200 to 250,000 electric vehicles in 2024, and they want to get to not quite gross profit by the end of 2024. So still not profitable to make electric vehicles, but they're reducing those costs, and that should improve as they scale that business. And I think their EV product's pretty compelling. Cadillac Optiq, they've got a new Chevy Silverado EV that has launched in pretty small numbers, but that continues to roll out. And then Super Cruise, their autonomous driving, level 2 autonomous driving system, continues to roll out in more and more vehicles. They'll be on 22 vehicles by the end of this year. The other big thing, something I had a lot of questions about, they talked a little bit about, is Cruise. They are obviously operating in 3 cities. They are moving away from the Cruise Origin. That's that custom vehicle. It's like a little miniature bus. Could fit about 4 people in it, and the doors open like bus doors do. What management said is that they're focusing on the Bolt to roll this out because there was a lot of regulatory risk related to the Cruise Origin. So the Cruise Origin doesn't have traditional steering wheel, brake pedal, things like that regulations are built around. So if you don't have a vehicle that could be approved under the current regulatory environment, there's no point in developing that. So there's going to be about a $600 million write-down related to that. And so that's one of the reasons that net income looks a little bit worse than free cash flow, because it's a non-cash charge. So something to keep in mind there. But I think once they explained it, it does make sense. It doesn't seem like that design is completely off the table. It's just that if you're going to design and scale a vehicle, but you can only have a couple thousand on the road, what's the point? You might as well scale with a vehicle you can scale with, get more leverage from the newly designed Bolt, help lower the costs there, and then eventually move to maybe something like the Origin design. But that's the plan for now. That's kind of the foreseeable future until the regulations change. This was the big thing, and this is always what I look at first when earnings come out. They raised their guidance, $13 to $15 billion in EBIT adjusted is what they're now expecting. So that was up $500 million. Diluted earnings per share up 50 cents to $9.50 to $10.50. That means that shares are trading for about 5 times expected earnings for 2024. Auto free cash flow up $1 billion, $9.5 to $11.5 billion now. And EBIT adjusted margins 8 to 10%. So those are really solid margins for an automaker of this scale. This gives an idea of what the business looks like overall, all the different segments. You can see that GM North America was really the powerhouse, and that continues to be the story. That's always been the story for GM. GM International struggling a little bit more. They talked a lot about China. China is a very, very competitive market. It seems like they're going to be making some strategic changes there. Don't know if that means that they're going to try to get out of China altogether, but the team basically indicated that it doesn't seem like anybody in China is really interested in making money. They're interested in just gaining market share and producing more vehicles. So we've seen that from manufacturers in China in the past. Doesn't seem like the story is any different. GM Financial continues to perform relatively well, $800 million in EBIT adjusted. And then obviously, as you would expect, losses from Cruise and losses from corporate eliminations. That's how you get to this $4.4 billion in total company EBIT adjusted. You can see that volume was up, but also price was up. And this was, I think, the big surprise was that GM does have a little bit of pricing power in the market. Now they're expecting prices to come down in the second half of the year. That's one of the reasons that they're not quite expecting the free cash flow that they've seen in the first half of the year to continue in the second half. But the fact that they haven't had to give all that much on price when a lot of competitors are, I think is a really good sign of their positioning in the market and the products that they have right now. The one thing to keep an eye on, and this is going to maybe lead to a little bit of weakness, is the inventory. So this is inventory in dealers, 581,000 units. So that's quite a bit of inventory for dealers to be holding. But obviously management is going to be willing to reduce their production to keep the pricing and margins where they are. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So you add all of this up, and I think this was a phenomenal quarter from General Motors. Pricing power continues to be strong. They're refreshing their vehicles, I think, in a really compelling way. Their moves into electric vehicles are not necessarily as fast as a lot of people maybe want, but I think they're really prudent because they're going to try to make money in electric vehicles where a lot of their competitors are losing money and are losing money at an unsustainable rate at this point. So GM's being a little bit more conservative, and then they're using a lot of that cash that they're generating from the business to just simply buy back stock. So when you're buying back stock at a PE multiple of about 5, that is really accretive to the bottom line. They're going to likely buy back over 20% of shares outstanding between the end of November 2023 and November 2024. So that's exactly what you want to see when the market is not really appreciating your stock price. So really interesting, I thought, to see shares fall in trading on Tuesday because results were really positive, cash flow was really positive, and management has indicated, hey, if the stock price continues to be this low, we'll just aggressively buy it back. So maybe we get another aggressive buyback later on this year, but we'll see how that plays out. As a shareholder and a long-term shareholder, I don't see any reason to sell shares, and this may be a stock that I would add over the next couple of months. But let me know what you think of GM's results. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.